and given a lot of with all of the market situation being choppy, it just made more sense to actually tune out the noise. And one of the ways to tune out the noise is actually to nuke the positions so that we could really reevaluate on whether we really like the company and we want to collect those shares more and more. So for March 19, 2021, we are of the view that the market has peaked. They have peaked in several levels. Some companies peaked as early as December 2020. Some companies have peaked January. Some sectors peaked February. And some companies have not yet peaked, actually. So some companies will continue to make all-time highs even until April, May, June, July. And my theory is that around April to July, the peaks would be formed on your Flintstone categories. So Flintstones are your primitive or traditional airlines, your department stores, your hotels, your booking. So all of these travel or tourism related stocks or even your financials would likely peak next 3 months. So that's just my theory. It hasn't peaked yet. Therefore, the all-time highs could continue for certain sectors, for certain stocks. So what do you do if you are a bull? What you do is you need to learn how to sell put options as a strategy. And you also need to learn how to collect awesome 10x winners. So for those who are new, you might get a little bit lost with some of my terms. So just bear with me. Okay, in a bull market, this is something that I saw and I like to share it. In a bull market, one must avoid the error of the preening duck that quacks boastfully after a torrential rainstorm, thinking that its paddling skills have caused it to rise in the world. A right-thinking duck would instead compare its position after the downpour to that of the other ducks on the pond. That's what Mr. Warren Buffett said. As human beings, we have a natural tendency to gravitate towards positivity and optimism. We are natural bulls. While I give that there are benefits of adopting this perspective in many facets of life, I'm of the opinion that it might serve as a double-edged sword within the markets. I have in the past advocated constantly about sitting on a pile of cash, waiting to seize upon the right opportunity. Admittedly, the waiting has been the hardest thing to do. The difficulty is all the more compounded on days when the markets are up. We live in an increasingly on-demand society where gratification is delivered nigh instantaneously. Examples of this can be observed everywhere around us, such as faster internet connection, information delivery. And it is here that the words of the French mathematician Blaise Pascal ring ever come true. All of humanity's problems stem from man's inability to sit quietly in a room alone. We can't seem to stay still. That's the biggest hurdle of most investors. They know that the market is extended. We've talked about this in several classes. This is not the first class. So if this is your first class, do check our earlier weekly classes. There are sectors that have done lower highs. It's not impossible to have seen companies already falling 70% from their peaks. So if you weren't being cautious, then you didn't pile predict, not necessarily predict because we don't need to predict. You just need to watch the markets, prepare the cash when the market changes, which it really did. And you have to seize the opportunity when you see that the markets are giving you a lot of good companies at a huge margin of safety. So all that Warren Buffett here is saying is really caution and learn how to be patient. Because everybody doesn't really know that they aren't geniuses. 2020, they may have gotten 10x, 5x, even in March 2021. You can see a lot of cryptocurrency enthusiasts making 50x, 30x. So just go back to some of my classes because really this is more of a continuation of several classes this March. So this is what happened last night, 1.75% 10-year yield at today's high. It is continuing to rise. We see a potential move to about 2% Treasury yields. Now, some people would say 1.75%, 2%, it's actually relatively low. So we think that despite the 10-year yield going up to about 2%, we think that it is actually manageable. So there's nothing wrong with a 2% US 10-year treasury yield. But the market is frightened, and because of this, the market actually collapsed in a couple of weeks. So a few things that we can teach you is actually shared by our awesome 10x member. One of our awesome 10x member is said that he's glad that we mentioned put selling in one of our classes. We saw that this client or this student said that he is an options trader and he also does a lot of selling strategies. He sells calls, puts, iron condors, butterfly spreads. Most people who actually dabble into options mostly buy calls and puts. They don't use selling. Warren Buffett is indeed one of the biggest option seller in the world. So we discussed that actually the biggest investor knows how to use puts. He knows how to sell puts. The goal is to slowly bring down the average price of the stock that you own by simply earning the premium income through the options that he sells. So, example, we know that Apple is one of Warren Buffett's biggest holdings. If he likes to sell puts at $100, he collects the premiums thinking that Apple would never really drop to $100. Now, if it indeed fell to $100, he doesn't mind because the selling of 100 puts means that he is required to pay Apple at $100, which he happily will buy anyway. So that is one way that Warren Buffett actually is able to lower down his cost in companies that he is bullish upon. So option selling is just simply the opposite of options buying. If you're buying a call or a put, you actually buy and then you put a price and you want a stock to actually move in the money beyond your cost to earn. So if you're buying a call, you're assuming that that is a stock, it goes up. If you buy a put, it's like buying a short, you assume that that stock goes down. On the other hand, selling, you simply want the option to expire worthless so that you do get to keep the premium. In short, you're selling calls or puts so that those strike prices are prices that you believe that the price will never go into. Example, if it indeed fell on that price, if you really like the company anyway, then selling puts actually tells you that you are buying the stock. Selling calls actually means that you are selling the stock at that price. So that's really all. That's why we prefer that you learn how to sell calls and sell puts rather than buying. So example, what if Zoom video is $330 and you believe that Zoom will never go to $450 at an expiration date? An expiration date could be, let's say, April 2021, next month, 30 days, April, end of the month. So what you do is you sell the 450 calls. In your assumption, it will just expire worthless and then you just simply collect the premium because there will be nobody who'd actually buy Zoom video at 450 and exercise it unless Zoom video is trading at $600 or $650 or $451. Therefore, it will just expire worthless and you collect the premiums and that's how you make money. Now, on the other hand, let's assume that Zoom you think will never go below 200. What you simply do is you just sell a Zoom put at 200, which are currently gonna remain on the money until expiry. And if it expires and never hits 200, you still collect you would still collect that premium. Selling calls and selling puts simply allows you to get that credit premium. Selling are actually called credit trades. You receive the cash upon order execution. These are premiums paid by the other side who bought. Typically, a contract is one contract allows you to buy or sell 100 shares. So example, if you are a buy and hold investor, buying means that a most common option trade right now for most retail investors is simply to do a selling of a covered call. What does a covered call mean? It means that you own today 1,000 shares, example of Apple, you got in at $100. If the current price is $120 and you believe that Apple will never go beyond $140 simply because you believe that in the next month, the market is toppish, Apple will not break above 140, you would simply sell a call option at $140. You sell that $140 strike calls, you receive the premium. Let's assume it's $2 or $20. You receive that premium $2,000. When April comes and Apple does not ever reach above 140, you just get to keep the $2,000. You wash and rinse, repeat this every single month until your cost basis of Apple is technically down due to the monthly premiums that you receive. A lot of people who engage in call options, selling calls, selling puts, will usually tell you that only a black swan can actually render you wrong. Now, however, what is the problem if you actually are selling covered calls? It simply means that when $140 does reach, the upside is capped for you. You've got 1,000 shares of Apple. You then have to sell it. You are required to sell it at 140, which anyway, at the end of the day, you're still up $40 on your initial $100 cost. You just simply limited the upside that you were supposed to receive if Apple actually went to $200. So they get my point. Selling calls limits your upside. Selling puts limits your downside. But you have to understand that you sell calls when you're actually bearish. You sell puts when you are bullish. So hope that you understand these things. Now, if you are feeling bleeding nose and you need to start from scratch, you try to read the following Option Theory for Professional Trading, Varsity by Zerol Ha. I'm sorry if I didn't explain what a call and put to us. A call option is simply an obligation, like a piece of paper. That contract, let's say I buy one, let's say I'm selling because I'm teaching you to sell. I am selling Zoom video puts at $200, one contract. If I'm selling one contract of Zoom video put at $200, and let's say the price is $1, it means that I will receive 1 times 100 or $100. So I receive $100, it goes to my account like a credit. And that contract obligates me that if Zoom video actually fell at strike price of 200 within a single month, let's say I use 30 days. If Zoom video crashed tonight to $200, somebody's gonna act upon that put option because I gave him the right to sell Zoom at $200 strike. Now, if I was bullish on Zoom anyway, it's fine. I gave you the right to sell 100 shares of Zoom at 200, which means $20,000. I'm committed to pay $20,000 to this person because I want to own Zoom. So either I get $20,000 worth of Zoom at $200, which is a discount at current levels of $330, $300, or I simply collect that $100 premium. That's what selling puts mean. That's it. If you're new, you can actually make options. You can study a lot of options, but that is one way why some of the biggest bullish investors make money. They know how to sell puts and they know how to sell calls. If you know how to do that, then you can just collect the premiums every month. And that's one strategy for you to make money in 2021. Another thing that I could share for 2021 is the thesis that the markets have not really topped per stock. So I do think that the hotel stocks is still in a quagmire within the next 3-6 months. So I want to short the hotel stocks, but not yet. Wait for my timing. We have to study Marriott, Hilton, Host Hotel Resorts, Hyatt, and even Inn, Summit Inn. These are companies that I believe. Somebody's asking, is there no risk in selling puts? Well, the biggest risk in selling puts is that you are required to buy those shares. So you only sell puts on companies that you are bullish upon. So example, let's say I want to sell a Roblox put at $50. I'm required to pay $5,000 worth of Roblox 50 times 100 if Roblox did fall at $50. Now, if you will wonder what's the risk is, what if Roblox fell to $25? I'm still required to pay at $50. That's the biggest risk when you sell a put. So when you sell a put, make sure that the strike price that you choose is a price that you want to really buy that stock from. Example, I don't care if I sell a put on Airbnb. If I want to buy Airbnb at $100, then I'd collect the premium and then pay $100 times 100 shares or $10,000 worth of Airbnb when that happens. So just make sure that you have the cash to buy the stocks when those puts are actually exercised. In a huge market crash, a put would be exercised. The put is an obligation for the seller to sell at that price. You cannot back out. If you said that you are selling puts, example, on NASDAQ 10,000, you're required to buy that NASDAQ 10,000 forever until you pay for that. So that's the biggest risk, which in my view is not really a risk if I really want the stock long term. So I think that for most awesome 10X investors, selling puts is the way to go because we want to buy those stocks for the long term. In the meantime, while selling those puts, we collect the premiums. That's it. Now, if you think about it, will selling the puts actually give you a lot of money? Sometimes not a lot, because even the people know that there's no such thing as being able to perhaps buy Roblox at $50. So sometimes you have to check if there's really somebody who's willing to buy those puts at $50. So it's still a bet. You are selling the put. Somebody's going to buy that Roblox from you. You never know. Maybe they think that Roblox is supposed to be $25. That's why they're willing to sell puts. And I mean, they're willing to buy your puts at 50. If you are wrong that you sold the put at 50, remember, you are required to buy it at that level. Okay? So there are a few things to do. Okay, let's say very simply, how do you make money in 2021 aside from selling put options? That's just one. You can also short the companies or the sectors that you don't believe in. So in my view, the recovery, the reopening has been extended. Marriott, Hilton, Host Hotels, Hyatt. I think that for the longest time, most people already had an alternative. And with market caps today of 40 billion, 30 billion, 10 billion, and $7 billion, and with very little demand in terms of travel reopening on a worldwide scale. You could argue that the US reopening is great, that's good, but we are talking about the world, not US. We're talking about the world, not simply China reopening. So if there used to be tourists that's actually going to Marriott hotels worldwide, tourists going to Hilton hotels, Host hotels, and Hyatt hotels, no matter how safe America is, the world does not simply rest on America. And therefore, within the next 3 months, in my view, the world will acknowledge that these hotels, which rallied back to pre-pandemic peaks, are extended and are worthy to be shorted. So how do you do it? Do you want to sell calls or do you want to simply short? That's twofold for you. There's a risk if you sell calls because selling calls gives you an unlimited risk. What is the unlimited risk when you sell a call? Selling a call is shorting Marriott. So I suggest that if you just want to not really like the company, you just simply short with a stop loss. Remember how many people got killed with their GME shorts. So just because we are entertaining selling puts does not mean that we are also oblivious. Let's assume that you're stupid, that you sold a put option, you sold the call option on Apple. Let's assume that you were thinking that, oh, it's too extended. Marriott will never go to $200. Let's give you the chart of Marriott. Oh, anyway, this is a Cranberry song, the zombie song. So I think that personally, this is just my opinion. I think that these stocks, these hotels are actually zombie companies. They actually should be laying off employees, but because of the fact that there was a stimulus. Now, I know that some people would say that, Nikki, you're bad. You're actually condoning laying off employees. But this isn't me being bad. This is me simply telling you that the business cycle has changed, and it's unlikely for these companies to actually be able to get their revenues same as the year 2019. And even if you say there's stimulus, how many people and how many households actually would spend like there's no tomorrow and travel, even if they wanted to travel, when a lot of the worldwide savings are actually in bankruptcy mode rather than getting a lot of money? So you have to actually think of the variables as well. So this is the song Zombie by Cranberries. You can just play that song. So let's assume that I think that, this is a personal call. You might want to do it or you might not want to do it. So Hyatt Hotels is currently at $90. Let's assume that I really want to short sell Hyatt at 120 to 130. If I sell a call at $130, that means that somebody is obligated to buy Hyatt at 130, right? Because the only reason why selling calls at 130 would make sense and will get exercised is if Hyatt actually went to 150, right? So my view is that it will expire worthless in the next 1 month because Hyatt will not go 130. So that's my risk, right? If I sell a $130 call, my view is that Hyatt will not hit 130. When I sell that call, I collect a premium. Again, remember, what is a call option? A call option is the right. It is a contract. It is not the shares. It is just a derivative. It is simply the contract allowing this person to buy 100 shares of Hyatt at 120 or 130, which technically makes me naked short, right? Because if I happen to sell a call at 130 and this person exercises it, my risk is technically unlimited, right? That's why selling calls is more scary than selling puts. Because if I sell a put, the only rational thing is that if I bought it 100, it goes to zero. If I bought Roblox at 50, it goes to zero. That's the maximum risk. But if Hyatt Hotels, I sell calls at 130 and it went to $3,000, I could get wiped out, like the GME move. Now, this is something that I'm sharing to you, not for you to copy, but to simply explain to you that there are several ways to short a company. Either short it as a naked short or simply don't do anything as well. Okay, so if I view that this $90 is expensive, I could short it at 90. Where will be my stop loss? I could lose 20 to 30%, right? So it's easy for me to assume that, hey, instead of doing a straight short, I'd rather sell a call option at 120 or 130 for the next 3 months. So that's one way, all right? You collect the premium and you have the risk that if Hyatt Hotels went to 200, you're dead because you sold at 130, but you have to buy it back at 200. Understand, there is a risk. It's not a risk-free investment. It's not even an investment. These are called short-term trades. Okay? Granted, let's assume that you're of a different character. You can tell me, Nikki, I disagree with you. You can disagree. It's okay. All right. So let me just explain more ideas. So I think that Marriott Hotel is a zombie. It's currently trading at 150. I could do two things. I could sell calls at 150 or I could sell calls at 180. It's easier to sell calls at $180 in my view because it will just expire worthless. Because the problem is if I sell call at 150 and it actually went to $170, I'm obligated to really give him shares of Marriott, which I don't own. So I'm obligated to pay it, right? So I prefer selling calls that are higher than the current price. So $180, thinking that it will never go 20% up in the next 2 months. Now, if I'm wrong, I'm also screwed. I have to pay him Marriott shares, which I don't own. Remember that. Hilton Hotels, same thing. If I believe that the entire hotel industry is a short, then take a look at the charts. These were their current levels. It's already at all-time highs. If I don't believe these all-time high moves, I just simply sell calls. So selling calls on Hilton Worldwide, selling call options on host hotels and resorts. This might even be a better short because it's lower high. Unlike this one, which is at all-time highs, this is at the same high, this is at the same high. Host Hotels is a smaller company. Therefore, there are people who believe that it's not going to go all-time high. So let's say you don't believe in it as well. It's currently at 18. You could sell a call at $22. And hopefully it just expires worthless so that you just collect the premium. In is also lower highs. 20 is now trading at 10. It hasn't reached that $20. So I didn't study the fundamentals of these companies, but from an industry perspective, I'm thinking that this industry is weak. So whether I short it individually in the next 3 months or I simply sell a call option 3 months from now at higher levels at about 12 or 14. 20% or 40% higher than current levels. So those are just my expectations that it will just expire worthless. If it expires worthless, then I just collect those premiums and nobody will actually bother me. And that's it. Now, Airbnb, I don't really like to short it, but you could see that these are quadruple tops. Your Airbnb right now is it's already $100 billion. It's priced in for perfection. Everyone is already saying that Airbnb has already disrupted the entire hotel market share, the entire trip advisor, the entire booking. That's what the market cap of Airbnb today is. It's expensive, that is always going to be expensive, which in my view, in fairness to that theory, I will never really short Airbnb. I simply would prefer waiting 112 all the way to 85. So what will I do? If I like Airbnb and I want to buy these shares at 112 to 85, it's the reverse. Instead of selling calls, I sell puts. I would sell puts on Airbnb, which is trading today at $190. I'd give you the right. When you sell a put, you give the right for somebody to exercise the price to sell Airbnb at $112. So you're giving him, you're writing an insurance, you're writing a contract. Let's write a contract that I am willing to pay 100 shares of Airbnb at 112. Well, anyway, if you prefer to buy Airbnb as a stock long-term conviction play, selling a put on Airbnb just makes so much sense. And getting rewarded while waiting is such a great strategy too. So that's one way of making and enhancing your 2021 return performance simply by selling puts or selling calls. Get my point? You are supposed to exercise only when the strike price actually happens. Let's assume the stock price collapsed in 2 months and you got the strike price of 112. What it simply means is that you are now required to buy Airbnb 100 shares at 112, which is what you wanted to do anyway. So what's wrong with that? Win-win. Now, the doomsday preppers today are hiding in silver, but I will just hide in cash. Or maybe some of my high quality favorite loved ones. But I just wanted you to see that for the last 10 years, we are seeing a momentous bull run on silver. Why will silver go up? Reddit loves this, the GME crowd loves this, the doomsday preppers love this. They're saying that the gold to silver ratio is at an all-time low, meaning silver is so cheap versus your gold. And they're also saying the industrial demand for silver is very high, given that silver is actually an industrial demand. You don't wear it for jewelry. You actually use it for a lot of electronic components, renewable energy, storage batteries, electric vehicles, and so forth. So I can get the bulls because I'm also a long-term believer on these secular trends. And it is very clear that silver here is a strong breakout in the last 8 years. In the last 8 years, silver never broke above $20. From 20, it languished to 10. It was a decade of nothing on silver. And right now, can 20 go to $40? There's one way of making sure that if you are a bull on silver, this is the ticker symbol SLV. This is a silver ETF. So it's like a bullion, same like gold, like GLDs. Okay. So if you are truly a believer of SLV, you can do two things. Again, I said, if you wanted to buy silver at $20, all you simply have to do is to sell a put on SLV at $20. If SLV expires, if those puts expire, then you just collected the premium. But if you really have to initiate those buys, then you are required to pay 20 times 100 or $2,000 worth of silver, which you perhaps intended to really have in the first place. Okay? Remember what I said, selling puts is the actualization of buying the stock. Selling calls is the actualization of really selling those shares at a high price. Now, there's a great video that I want you to know. This was made by Casgen's Academy. Kathy Wood's huge new bet on one stock. She bought $2.4 billion on Teledoc. Now, a lot of you know about ARC Genomic Fund. You are aware that ARC Genomic Fund's largest position is Teledoc, TDOC. Let's explain why Kathy Wood, we believe, has made the right call. Anyway, you can watch this 9 minutes. This is a very good video. I'll give you simply a small understanding why I believe it. The telehealth market size is expected to double, quadruple in the next 10 years. Let me give you a simple rule of 72. If you can compound your money at a rate of 24% every year, in 3 years, you double. In the next 3 years, you double again. So that means 1, 2, 4, 8. 3, 6, 9. So in 9 years, you 8x, right? That is the kind of reward that Teledoc can give you in the next 7 years or 10 years. So if you believe that every American in the world is gonna use Teledoc, just like how every American today uses Netflix, just like everyone in the world uses Zoom video. If you can see it very clearly that everyone in the world is gonna ride an electric car like a Tesla, that everyone in the world is gonna teach their kids online through Zoom video or do games through Roblox, if you can believe in that theory and bet on it, this is one way to do so. A high conviction bet on Teledoc is simply owning the leader of telehealth in USA, which can actually even expand to Canada and to many other countries. Because telehealth is not simply a US market size. So there's gonna be growth in the next 10 years. What does Teledoc do? Telehealth industry secular trend. They've already gone a 360 process. They had their strong position, Teledoc Primary 360 for success. It's a new approach to primary care. It's actually a cheaper way to diagnose and treat you, refer and coordinate you, help you prevent your next few diseases, and to monitor you and to manage your health. A patient and care team which you can see and find a doctor through the comfort of your mobile phone or any device. That's why it's telehealth. A lot of people know that Zoom video and telehealth are almost verbs. Italadoc mo na yan. Well, in the Philippines, we can't say that because Philippines. But in the US, it is a verb. It is a verb. Kung Zoom is a verb, Teledoc is a verb. Impressive initial outcomes. You can detect early chronic diseases, 50% of hypertension diagnoses at first time, greater than 70 distinct diagnoses. Okay, I discussed a lot of the reasons why I like Teledoc in one of our inner circle classes, so I'm not going to repeat it here. But let's just tell you that the visitations right now has become the norm. Telehealth visits are the norm because people have felt that it's more convenient to just visit their doctors online. They don't want to go to the hospital, wait hours, if they can afford to meet that doctor and have an appointment online. It's cheaper, more convenient, and overall happy for both customers and the doctors. So they can address so far obesity, hypertension, anxiety, depression, MSK, diabetes. These are all addressed by Teledoc Health Solutions. They have a care coordination as well in network specialists. They commercialize this with multiple partners as of January 2021. And to have a 95 NPS is most important. Net Promoter Score, NPS. How many companies are actually an NPS of 95? Only cults. Only Apple, Tesla, Starbucks, Lemonade. Only a few companies. I think Zoom Video also has a very high Net Promoter Score. Actually, guys, because we believe in bigger businesses that are gonna capture the scale and monopolize it, this is the reason why, even if I said that Amwell has a bite on the secular trend of telehealth, it makes more sense to actually own the number one rather than the number two, three, four, or five, or six, or seven. The number one is Teledoc. So you want to own the best of the breed, and this is one of them. It is still too early, and they are still early scratching the surface. Can you imagine if you invested in Netflix, say, early on, and people were saying, oh, you're late, and people were telling you that you were late 2010? Because it started 20 years ago, and you felt that, oh, 10 years after, I'm late. Teledoc is already 5 years old, so you might feel, oh, I'm late. But is it really? Nope. You're not early, but you're not late. Still, it's true, the earliest investors of Teledoc did 15x their money. It was $20 before, went to 300, and now for the better price of $180, tada, we can get it at about 40% discount. Maybe we can even get it at 50% discount. Should we pay for Teledoc? Okay, there is a huge white space, significant growth in the relationship of Teledoc members today. There is an assumption that with 320 million population, you currently have 73 million Teledoc members, and there might be another 65 million customers that are potentially using more US telehealth services. There is still significant room to grow for chronic condition products. The US diabetes and hypertension white space is also huge. There already are relationships that can expand the Livongo and Rollies. When I hear this, it helps me remember the net retention rate typical of SaaS firms. Wow, I can upsell. Do you know a company that loves to do upsell? Well, you remember McDonald's. Whenever you buy a burger, they'll upsell you by, do you want to add it with fries? And you want to upsize it with Coke and fries. Do you know how McDonald's makes tons of money? It's from those upsells. Because those upsells actually contribute around 30 to 50% higher margin to them because it's just a cola. And the French fries was actually cheaper if you just upsize it. So in general, some people actually don't even finish their fries and Coke. It actually contributes to obesity, yes, and also, but then again, that's what we are. Even if you can't finish a large Coke or a large fries, or I don't know if you really love to upsize all of your fries and Coke, the tendency for most people who upsize them generally don't get to finish them. So sadly, higher sales, higher revenues, and higher obesity too. And diabetes is actually a function of obese people. And the market for obesity is huge. 18 million potential users of current Teledoc patients. And they currently have 500,000 Livongo enrollees as of third quarter 2020. If you just simply believe in addressing obesity, then you might think about Senseonics, which is also PIC, but it's a small company. Or you can also assume Insulet Pod, which is PODD, or Dexcom. We actually argue that because Dexcom and Insulet Pod are a bit expensive, Senseonics, which is cheaper, is a potential idea. Either way, we are different topic already. The point here is that telehealth services have more leeway to go. And I will remind you what Bill Gates said. It's easy for people to overestimate what can be achieved in a single year, but they underestimate every time what we could achieve in the next 10 years. Can you imagine every single person born and every single person in the future and the current ones and all the people will actually be a potential Teledoc client? And perhaps not just America, but more countries as well. So Teledoc already has 2 times more visitations than their closest peer, which is Amwell. I do believe in this trend: telehealth, remote patient monitoring, diagnose it, prevent the disease with AI. So I believe in these things. And I think that it's going to get bigger over time. Now, another belief that I have with 2021 is that Tesla will continue to remain a strong leader. I understand this is an extension, and all the time extensions will consolidate and then go up again. So Tesla, in my view, is not a reversal, simply an extension. An extension can be cured simply by time. You just simply consolidate in the next 6 months. Even in June, if you want to sell a Tesla put at $330 or $390, all it means is that you're willing to buy Tesla at $330 and $390 if that ever happens. Meanwhile, you collect the premiums. So just keep on collecting the premiums in the next 3 to 6 months if you think that an apocalypse is gonna happen. Collect the premiums by selling puts on Tesla. Collect the premiums selling puts on a company like Teledoc. And that's how you make some money. And when it strikes, when the strike price happens, you're happy anyway because you get to buy the shares that you always wanted in the first place. There are some doubts. People don't know if Tesla can succeed in India. But I think it's important to just simply know that Tesla is a worldwide company. And I hope that they succeed in all the matters that they want to succeed in. Stop this. You can watch that CNBC. Another company that I'd love to do if I'm going to sell put options for is Palantir. The current price of Palantir is 24. Let's assume I want to own Palantir $20 even if the risk is it goes to 16. What do I do? Again, sell a put at $20. It's simple. If you are used to buying Palantir at $20, you simply sell a put, one put, sell one Palantir contract put at $20. Selling put options simply allows you to collect premiums. And if the worst case did happen, it's not really a worst case because you are simply obliged to buy Palantir 100 shares at $20, which is $2,000. You wanted it in the first place, didn't you? Okay, so there's a lot of interviews about Alex Karp, and this is a very strong video. That's why I want you to subscribe to Investing Opportunity. I saw the video, I like it, and there's a lot of videos that they share. So I'm happy to just retweet or reshare a great company when I see one, and a great video documentary or a great interview cut. So just watch this. This was an actual interview on Alex Karp about Palantir's results and as well as the volatility on Palantir. The more volatile the market goes, the better for your put options. You're selling a put, it means that options actually have three important things. The volatility, which is that, forgot, that's zero. Is it called gamma? For my college, I forgot. So I know how to. Is that an omega? Can you see? I remember, oh wait, or was it Delta? Anyway, it's been a long time since I did options, and that was since college. But yeah, options is a function of the strike price, the time expiration date, and the volatility. The higher the volatility of the stock, the more likely that the strike price gets hit. How high is the probability that Palantir can go $20? Very high, given that the market is currently in a haywire mode. And so selling puts actually gives you a premium. The more volatile it is, the better the premiums are. So you can collect those premiums. And the worst that happens is that, well, it never really falls to $20. And so the only thing that you did was collect the premium and you never got to buy Palantir shares, which you've always wanted. That's something that you have to also understand when you are selling puts. You sold puts on Palantir, but you never got the shares. You just got money. So alien technology, alien included. I agree. I love to invest in companies that are changing the world, and Palantir just happens to be one of those creatures. Kraft Heinz is a non-exotic pick. Now, this might actually present to you, wow, why is Nikki giving a ketchup brand? Yeah, so imagine this, $100 fell down to $20. This is a cornered stock. How cornered is it? Kraft Heinz is 27% owned by Mr. Warren Buffett. Charlie Munger, Warren Buffett has a huge stake on Kraft Heinz. Yes, the ketchup mayo brand, which actually earns something like about $1.50 per year. And they pay about 4% as well in dividends every year. So they've got cash flows, they are cash rich. At $40, that means that you are paying roughly 40 divided by 1.5 is about 20. Math, please. 40 divided by 1.5. It's below 30. It's about 25. It's less than 25 times PE. It's 23 times PE. So it's a 23 times price to earnings ratio. It's a flat company, meaning it doesn't grow a lot, but it's a very stable company. Warren Buffett likes those types of companies, stable, doomsday prepping. So the doomsday preppers would probably like to own some Kraft Heinz. Let me answer a few questions. Somebody's asking, hi, I have a question. If I sell a put on Palantir, how is it different with limiting at that same amount? Selling a put means you're collecting a premium. So if you sell a put, it goes to your premium. So it's a contract. You are obliged to pay, let's say I sell one Palantir put at $20. I'm obliged to pay 100 shares of Palantir at 20 within 1 month if it really goes down at 20 below. The only reason why this person who bought that put is going to exercise the right to sell Palantir at $20 is because he can see that Palantir shares are trading at 19 or 18. So that's what it means. It's like I have to pay 100 shares of Palantir at 20 when I can perhaps buy Palantir shares at 19 and 18. So do you get my point? Yes, there's a risk, but the risk is limited if you really like the company anyway. That's all. Hope that helps. So example, if I like Kraft Heinz and I believe in Warren Buffett and Charlie Munger and Michael Burry too, yes, Kraft Heinz is a position of Michael Burry, the Big Short. Yes. So the doomsday preppers are hiding in ketchup and mayo. So I think that, sure, I studied the fundamentals. It looks like $30 is a great opportunity to enter. Simple. Sell Kraft Heinz puts at $30. Every time you want to buy at 30, it's like, oh, buying means selling puts. Collect the premium. So this is your Kraft Heinz. 26% stakeholder is Warren Buffett. Michael Burry is also in a buy mode. It's 20 times multiple. It's a 4% cash flow yield. You still will eat ketchup and cheese no matter what. Macaroni and cheese, turkey bologna, Philadelphia cheesecake. This is the ultimate doomsday prepper asset safe haven. Hooray! So anyway, this is a doomsday prepper idea. So you can understand that March 2021, I am still of the view that we are in the Armageddon. But Armageddon does not mean that you go hide in cash. Why would you hide in cash when you can collect great premiums by selling great company puts? So, find companies that you would love to own anyway in a doomsday collapse, sell puts in the meantime, and I think that's a one way to make some money. Now, Kraft Heinz is good for the tortoise. What's a tortoise? It's a tortoise is a stock market animal, which I believe is a cost averaging long-term player. So we said that make money while sleeping, make money while sleeping. It's not a 10x company. This actually reminds me of Kellogg's, Conagra Foods. It's just a consumer staple. I'm not gonna eat 10 times more ketchup tomorrow. I'm not gonna eat 10 times more mac and cheese, but it will protect me. It's perhaps a 15% compounder, bro. So within 5 years' time, I do think that you hit a 1x on them. Rule number one, strive to save 10 to 20% of your income. We actually said 25%. Let's assume you earn $1,000 in a single month. You should allocate 25% or $250 into your stock market global account. You're supposed to save that no matter if hell or heaven came. That's supposed to be a rule, automatic. No such thing as I don't have money, that's why I'm not going to invest today. You will still invest. That's why you will save that 25%. And then what will you invest in? Okay. If you can save $1,000, let's say you want to put it in 4 stocks, let's own $250 of Teledoc, Zoom Video, Palantir, and Tesla. These are, in my view, blue chips already. It's not really going to help you do 10x. The 10x in them has happened maybe 5 years ago if you were investing early on in them. With Palantir, you might be able to 10x, but probably just 5x, given that it already doubled since the direct listing last year of about $9 to $10. Either way, even if it's just a 3x or a 5x, what does a 3x mean? If I buy it at about 170, I'm gonna make $500. So times 3. If $300 Zoom, times 3 is 900. If Palantir is 20, times 3 is 60. If Tesla is 550, times 3 is about 1.6. So 3 to 5x. Calling all the tortoises, those who just want to park their money and cost average it. If you have $1,000, cost average these companies, let's say divide it by 4, $250 worth of Teledoc. You can do fractional shares with IBKR. Interactive Brokers is my preferred stock market brokerage account. Now, of course, you could use TD Ameritrade, your Robinhood, your SoFi, your Square, your Ameritrade, your E-Trade, Webull, Futu, and all of the other brokerage firms that you use. So whatever brokerage firm you use, please use and collect and just invest for the next 5 to 10 years and see whether telehealth, video conferencing, data analytics, and softwares in cybersecurity also, Palantir also helps that, artificial intelligence, and of course, how electric vehicles, the thing about Tesla is it's not even just Tesla, right? It's not even just EVs. So Tesla owns the Boring Company, SpaceX, OpenAI, Neuralink, the satellite networks. So there's a lot. It's not just an EV company. So I do hope your entries get filled and then you make money while sleeping and you can sleep well. You will never let the bed bugs bite because you know what company you own. So a few things to understand. There's another company in the SPAC field that is interesting. It's called Evolve. So it's actually Bill Gates' new bet on a stock. The IP portfolio is wonderful. They've got core tech patents. It's actually a SPAC, a special purpose acquisition company. The ticker symbol is NHIC, New Hold Investment Corp. It's Evolve, EVLV. All SPACs start at 10, so it's now 10:45. If you believe that in the future, COVID is a very recurring theme in the next 10 years, this is an AI security for physical venues. So let's say you want to go back to the office, you want to go back to the hotels, the malls, the airports. Instead of a metal detector, what New Hold Investment Corp does is an AI, and then it's physical security. They can detect all COVID symptoms, etc., etc. Now, there is a legitimate business to evaluate the $10 SPACs, but at the moment, I also believe that the reason why you don't see me buying a lot of SPACs, despite the fact that, hey, I really see $100 to $500 move here, the only reason why I haven't bought a lot of SPACs again is because I think that SPACs carry a lot of margin. And if I have to guess, a lot of Reddit fueled Revolution, GME holders, even the BTC holders might suffer a margin call if volatility hits. Volatility does not render that secular trend to reverse, but volatility can render them 20-50% drops, which might enable a forced selling or a margin liquidation that they might not want, such that SPACs might even go below 10, which means that I think that I might even be able to buy some SPACs at $9 or even less. So if it's a good SPAC, I'll even buy it at 9 and 8. I don't mind averaging down. Anyway, it hasn't happened, but I'm just waiting. So this is a good video about this big bet by Mcash, the $1.7 billion bet of Bill Gates. Okay, you watch it on your own free time. And I want you to know something. I've said to everyone that even the great Shopify, when it made an IPO in the last 2015, it was actually halved. So Toby Lutke here at about $40 actually fell here to about 25, rallied to 40, and even a year after IPO, it went down to $20. Only after about a year and 2 years after did it break above that $40. So I think that it has to do with valuation. It had to ripen before it went from 40 all the way to about 400, corrected to 300, 200, now at about $1,000, $1,100. So can you imagine if you bought 20, 1,000 shares at 20? Right now, that $20,000 is $1.1 million in just 5 years. Wonderful, right? That's how great companies are. And that's what Awesome 10X wants you to have. So there are some companies that I feel that I'd love to buy, even in the 50 cent category. I've always said that I've been a believer of esports, and Real Luck Group is in Toronto Stock Exchange. This is something that is just my ideas. I was buying here at about 70 cents. I sold when I saw that the market seems to be collapsing and crashing. I sold actually somewhere here at about 150. And then I haven't entered back yet. I think that anyone who still hasn't sold would be selling it. The upside is slower than the downside. At about $1, it can go to 40 cents or even 50 cents. I'd happily get in there. Now, if it doesn't drop, it doesn't drop. It's okay. I think that people would still sell it at $1.50 anyway. So whether the people who got in at $1 or 60 cents or even those IPOs at about 40 cents. IPO of Luck is about 40 cents. This is Luckbox. It is the largest in Canada when it comes to esports betting. So you have to be a believer that people would bet on esports just like what they do in sports right now. You want to watch a game, you want to see whether Team Liquid or Team 100 Thieves will win, or Cloud Cloud9. These are famous teams. If you think, or I mean, just think of it in basketball. You have a team, right? Atlanta Hawks, Cleveland Cavaliers, or anyway, whatever it is, that San Antonio Spurs. So you bet, right? So sports betting, esports betting, who is the biggest in Canada? It's Luck. So there. There's more companies, but I just hope that you learned something in today's topic. Selling put options as a strategy is a way for you to collect premiums and a way for you to collect awesome 10x winners in response. If you need more ideas, go to just Investopedia. What is a call option, a put option? Hope you learned something in today's class, and inviting all of you to, of course, just sign in to Awesome 10X. We have many videos for you for free every Friday, or you can just attend our classes every day, go to our check out our testimonials, our clientele, and